Good morning, everybody. Welcome to Windsor Brokers Live Daily Market Outlook for Friday, 8th of February 2012. We are at the last day of the week. A lot of activities in the market, mainly triggered by yesterday's central bank's decisions, basically mainly by Mario Draghi's comments that pushed euro significantly lower, while sterling appreciated as there was no comments about QE that is for now seen supportive and is in the positive path, approaching heading towards 158 with yesterday's high at 157.67 seen so far, while euro is the top loser of among the majors after yesterday's release of the rates that was expected to stay unchanged, but the comments of European Central Bank chief had a great impact on the single currency, as he hinted concerns about the impact of the currency's recent strength on the Eurozone's economy, and that was basically beyond the expectations of most of analysts that were presented before the release. The Mario Draghi said that exchange rate is important for growth and the price stability, and that he wants to see whether the appreciation is sustained and will alter the risk assessments. He said that economic activity in the Eurozone area should recover gradually in 2013, but added that there are more negative risks than positive. Basically, he said that at least the first half of 2013 will be still dominating negative tone, while some positive hints might be expected in the second half. But as he noted, more negative than positive tones are seen so far. He said that he got the impression that the euro went the greater depth than expected, and the last month he just read out a G20 statement when he was talking about currencies. The euro slipped against US dollar and also lost against British pound, hitting the 2-week low, which broadly strengthened after incoming Bank of England Governor Mark Carney gave no hints that he favored the immediate easing monetary policy. And as current situation shows, after the brief consolidation overnight, the negative tone still dominates on the single currency. From other important things, China exports and imports surged in the recent overnight releases, with the trade balance also showing an increased surplus to 29.2 billion yuan compared to 24.3 expectation, but still below the previous 31.6 billion release. German trade 2012 trade surplus rises, but December is still seen as weak. As ECB said, will monitor impact on the Eurozone strength. This is what we were talking about. As they said, they will impact of the strengthening euro and feeding expectations. The climbing currency could open the door to an interest rate cut. I think this is yesterday's reaction was immediate reaction on his comments. From today's calendar, that is not very rich on Friday, but after yesterday's full calendar and a lot of events, as we said, the Chinese trade balance came at 29.2 billion. Better than expected, but still below the December's release. Economy watcher sentiment from Japan showed a great improvement, 49.5 compared to December's 45.8 and the 48.2 forecast. Chinese inflation dropped from the December's 2.5% to 2% versus 2.1% forecast. Unemployment rate in Switzerland came 0.1% higher from December, 3.1% according to the forecast. As said, German trade balance jumped, increased. Basically, the Trading surplus increased to 16.8 billion euros from in December from 14.6 billion euros in the month of November and 13.7 billion forecast, with also improvement showed on the Swiss retail sales for December. Yearly release shows year-on-year release shows 5.1% increase in the month of December compared to 2.9 in November, and forecasted 3.2. Still to come, important releases are coming from Canada mainly today. We have unemployment rate for January that is expected to tick higher to 7.2% compared to 7.1% in December. Employment changes showing 4,500 adding new jobs compared to 39.8 thousand in the month of December decrease. And the Canadian trade balance is according to the forecast expected to jump into the positive territory to show the 1.5 billion Canadian dollars surplus compared to the gap of 2 billion Canadian dollars in the month of November. US trade balance, these are all at 13.30, except the housing starts that I didn't mention that are due at 13.15 GMT, and approximately the similar to the previous release of December at 189,000 units started in December. Forecast is 196,000 in January. And finally, the US trade balance that is due at the same time, 13.30, is expected to show brief narrowing in the trading gap to 45.8 billion US dollars versus the November's trading gap at 48.7 billion US dollar. These are basically US data now are coming as the highlights of the day. US and Canadian data, pardon, are coming as highlights of the day, and the most of focus should be on these releases. And we're going to take a look now at technicals, as this is now becoming, it's basically for today especially is the most interesting part. Euro on significant dip, as we can see on the 4-hour chart from last Friday's peak at 137.10. There was initial dip to 134.58 and subsequent triangular shape consolidation that failed at yesterday at 135.76. We mentioned yesterday's comments that upside requires a regain of minimum 136 in order to improve the structure and signal higher low, but unfortunately after the comments of Mario Draghi, the euro just lost ground, accelerating through important 135.00 and 134.58 supports, also losing 134 as a strong support previous range top, dipping as low as 133.70. that marks 50% of the uplink from 130.37 to 137.10. Brief consolidation is now seen just above the recent low, though the upside remains limited by descending 10 days moving average on the hourly chart, and the negative readings still showing on the hourly chart, keeping the upside so far protected. Next good resistances are at 134.58, which is the previous low of 5th of February, and then 135 zone low of 6th of February, and the previous supports now acting as resistance, and both the later one is reinforced by bearish 20 over 55 days exponential moving average crossovers, and see for now the upside protected according to the structure on the 1 and 4 hour chart that still maintains a negative tone and sees the downside favored for now. Any penetration through 135 would improve, would avert basically immediate downside risk, and look for test of 35.76, which we see as the main requirement in order to shift the focus higher, 135 towards 136, and then key barriers at 137 zone. Otherwise, as we said, the negative tone that dominates on the near term, on the lower time frame, still sees potential for further easing and further reversal, as a loss of 133.70 recent high would open 133.00, which is close to 61.8% retracement, and then the higher platform base at 132.65. These are seen as the next downside targets in case of a further extension higher. That is so far seen favored. From the other side, underlying bull trend still seen on the daily chart is still, I would say, in a way unobstructed, despite the pair broke the initial trend line drawn from 130.37 through 132.64 and 132.85. Still, another trend lines are still intact at this point. 132.16 approximately is the one drawn from 126.60, and then the larger one from low of 2012 at 120.42 that currently stands approximately at 131.65. Basically 131.65.70 is seen as a break point for the single currency. We have the previous highs of September 2012 accompanied with the main bull trend line drawn of 120.42, and a break below 131.70 would be a signal that the current strong rally from July 2012 is over, and the pair is entering the major corrective phase. Otherwise, still bullish structure above I would say 132.65 would still keep the upside focused on the larger picture. From the Ichimoku studies, we're going to take a brief look here and see the daily structure is still well supported, though the price lost the Tenkan Sen, but still holding above Kijun Sen and well above the daily cloud, while 4 hour is now giving full negative signal. Price below the cloud, below the Tenkan Sen, below the Kijun Sen, that is still in the cloud, but overall a negative tone keeps the downside favored according to the Ichimoku studies. British pound again the ground after yesterday's comments of Bank of England governor, the rate decision to keep the rates and the quantitative easing unchanged. Spike higher above the initial congestion, which is approximately at 156.70.80, and then break above 157 resulted in a spike to 157.67. So far, with the subsequent pullback in stabilization seen above 157 support, that also marks the two major near-term moving averages of 20 and 55 days that are at this zone, with the bullish crossover now underpinning the current action, as the hourly studies are still holding positive tone. Major requirement on the upside is seen on the regain of one minimum 157.67, and the more significant is 158 zone. This is the peak of 5th of February. That is required to confirm the near-term base at 156.30 and allow for some stronger corrective action. Further retracement of the larger down leg from 158.77 to 156.30 with a clear break above 158 and weekly close above these levels would be initial signal of possible stronger correction, as the pair remains in the stronger downtrend, and any failure and upside rejection under 158 barrier would be again signaling a continuation of series of lower tops that would keep the downside vulnerable, and the shift focus again towards our key near-term supports at 156.30 and 156.00. Dollar yen accelerates its near-term corrective action after a break about below initial support at 93.00. This was the range, consolidative range floor, with fresh extension seen yesterday and overnight, as well as at the beginning of European session, now threatening a 92.17, a 92 zone. That is the our break point for the for in the near term. 91. I do apologize. I think we are not on the right chart. 8805. Okay, it's just testing a 50% retracement of the 90. I do do apologize. It's 31 to 94, 94.02. And testing also the ascending 55 days exponential moving average of the 4-hour chart with the 92 zone seen as a breakpoint. We have the lows of 5th of February, and this is close to 50, between 50 and 61.8%. This will seen as a trigger for a stronger corrective action. Otherwise, holding above 92, which is quite unlikely at this point, as we're witnessing the hourly studies in the negative territory, and the 4-hour indicators in descending mode, building up bearish momentum that overall gives negative signal and sees potential for further retracement. Would slide below 92.00 to open the next supports 91.70 and 91.40 previous 91.40, 91.24 previous highs. This will be basically signal for some more significant corrective action, as if we take the look at the larger upleg from 88.05 to 94.02 so far. The pair is basically approaching a 38.2% retracement that is currently standing at 91.74, as indicators are in the negative, in the descending mode, as well as daily indicators that started to point lower. Of course, confirmation will be given on the break and the weekly close below 92, with the double doji seen in past two sessions showing the at least indecision and the possible fatigue of the current strong uptrend that lasts from November 2012 from 79. This is the latest upleg. Possibility of stronger corrective action possibilities are quite strong at this point. Still, confirmation requires a break and close below minimum 92.00. That will be next signal for some stronger reversal and the correction of this strong trend that jumped from 79.20 to 94.02 without any more significant corrective action seen so far. From Ichimoku studies, 4-hour indicators are giving initial negative signal as the pair broke below the moving averages, facing now the cloud top, which is approximately at 92.00. This is reinforcing our support, while daily Ichimokus are still well bullish. Initial support now being tested. The daily Tenkan-sen line currently at 92.16 has so far contained the morning's dips. And the dollar Swiss improves the near-term structure after break. I think better seen on the 4-hour chart. A break above the initial congestion at 91.20. There was initial break yesterday at 291.50, but short lived as the price dipped below 91.00, and then fresh strength came after yesterday's central bank comments that boosted the US dollar. So far, the pair tested the 92.00. Our next significant target that marks also 50% retracement of the downleg from 93.87 to 90.20, signaling basic attempt from 90.20 is now gaining a pace, but still break above 92, and another Fibonacci barrier at 92.50 is required to confirm. A weekly close above 92 minimum would be seen as a supportive element, as ascending 20 days moving average is now approaching the 55 days one, and this is basically showed as a initial support yesterday's intraday high at 91.50, reinforced by 55 days exponential moving average is offering initial support, and basically is seen as ideal reversal point. Should ideally contain dips in order to maintain the near-term bullish structure developed after breaking above 91.20 and then 91.50, with the 4-hour indicators now in the positive territory, seeing a potential for some stronger corrective action. Of course, the current consolidation, as we said, should hold above 91.50 as ideal support point in order to resume higher. And finally, from commodities, Crude oil is still within the range after testing a breakpoint and key support at 95.0, yesterday, 2 days ago. As a bounce higher remains capped at 97 zone. Recall we mentioned yesterday that a break above 97 is required to confirm recovery of 95 spike close in 2 days ago, and improve the current still negative structure as shown on the 4-hour chart. Immediate resistance now stands at approximately 96. First is 96.17, recent peak posted this morning, and then 96.50, which is the bearish 20-55 days moving averages crossover. But main barrier is at 97.00. That will signal a base at 95 and open shift focus again towards the upper boundaries, as the overall bullish trend is still intact, as the current dips stay approximately at the previous lows and above the break point at 95.00. That also marks 23.6% retracement of the uplift from 85.22 and 98.22. So holding above 95 keeps the positive structure still in play, but break above 97 is required to confirm and open shift focus again towards the upside. Until then, we'll be in the range and sideways movements. Basically, at this point, still more focus is still seen towards the downside based on the 4-hour technicals, as they are still maintaining a negative tone, and the more risk is seen for a possible retest of 95.00, and that will be the initial trigger for some stronger corrective action of the crude oil's price. So just to confirm that a break of either side is to define the near-term direction, but near-term structure is still aligned towards the downside, as long as holding below initial 96.50 and a key 97.00 barrier. That keeps risk on the downside at 95.50 and 95 as a key support, seen as a trigger for some stronger corrective action. Break of 95 would open way down towards 94.00 and then 93.25. That marks 38.2% retracement. As said, positive structure still seen on the daily, as first golden cross has appeared on the break of 55 over 200 days moving average, and the 90 days one is now about to break. That supports the theory of a strong uptrend that is still fully in play. As long as the initial 95.00 support holds. Otherwise, break here would be trigger for some more significant pullback following rally from 85.20 to 98.22. And finally, gold, bumpy ride again seen yesterday following the central bank's comments. Dip lower to 1662 that briefly broke below the redefined the range floor at 1666, but a quick recovery higher up to 1683. Range tops again keeps the yellow metal within the range. There is no spark to, there is no actually the something to trigger a break above or below the range to define the fresh direction. We are still entrenched between approximately 1665 and 1684, and the currently neutral tone still sees break of either side as a trigger for fresh to establish fresh direction. A break above 1684 and close above this level is to signal resumption of the recovery from 1651, and probably to refocus upside the barriers at 1684 and the 1695, while the loss of initial 1666 is to look for 1661 and 1657, and then finally strong support at 1651. As said, neutral tone, and the range trading is in past few days shows no direction for the yellow metal. And that will be all from me for today, Friday, 8th of 8th of February 2013. I wish you a nice last day of the week. Of course, relaxing weekend, and we are back on Monday at our regular time at 8 o'clock GMT. Until then, good luck in your trading and a lot of profits.